They just moved more paper silver in one single day than the entire world mines in 3 months. I'm not exaggerating. This is the biggest, most unprecedented silver positioning shift we've ever seen, and almost nobody is talking about what it really means, because buried inside this move is what I'm calling the silver exit. And 99% of investors are going to miss it. This wasn't random. This wasn't a coincidence. This was planned. Now, if you've been following this channel, you already know we've been tracking stress inside the silver market for months. We called the inventory drawdowns. We called the paper to physical divergence. And we warned that when this thing finally snapped, it wouldn't look like a clean breakout. It would look confusing, it would look boring, and that's exactly why it works. In the next few minutes, I'm going to show you 3 things. First, what just happened in silver, and the exact timeline nobody is laying out clearly. Second, the numbers, the contracts, the volume, the ratios that expose how extreme this move really was. And third, the hidden connection Wall Street analysts are completely ignoring, but central banks and bullion banks are clearly positioning for right now. And quick heads up, if you want to stay ahead of these kinds of moves before they show up in headlines, make sure you're subscribed. This is time sensitive, and what happens next doesn't give second chances. So let's start with the event itself. Over the last several trading sessions, silver has been aggressively capped at key technical levels: $23, $23.50, $24, levels that should have broken if this were a normal market. But instead of breaking out, something strange happened. Volume exploded, open interest spiked, and yet the price went nowhere. That combination rarely happens organically. When price stalls but volume surges, it means large players are exchanging positions, not exiting the market. Someone is getting out, and someone else is taking the other side. That's the first clue. Now look at the timing. This all happened right as COMEX inventories are sitting near multi-year lows, right as industrial demand forecasts are being revised higher, and right as sovereign debt issuance in the US is accelerating again. That timing matters, because silver doesn't move in isolation. It moves when pressure builds elsewhere. And here's where it gets interesting. According to the most recent COMEX data, silver futures volume surged to levels that imply more than 2.5 times the annual global mine supply was traded in paper form in just days. Let me say that again, because this is one of those blink and you miss it facts. Paper silver equivalent to multiple years of mining, traded without moving the price. That is not price discovery, that is price control. Now, for beginners watching this, here's the simple version. Silver exists in 2 markets: the physical market, bars, coins, industrial supply, and the paper market, futures contracts, options, derivatives. When paper volume completely overwhelms physical reality, price becomes a signal, not a truth, and signals can be manipulated. For the more advanced viewers, here's the deeper layer. Open interest didn't collapse after this volume spike. It rose. That means positions weren't closed. They were rolled, transferred, or restructured. In other words, the big money didn't leave silver. They changed how they're exposed. Now let's talk numbers, because this is where the story really breaks apart. Commercial traders, bullion banks, have been aggressively reducing short exposure relative to speculators. At the same time, managed money has been loading up on leveraged long positions that are extremely sensitive to margin changes. This creates a setup where price can be pushed down temporarily, forcing weak hands out, while strong hands quietly reposition. And here's the part nobody on financial TV is connecting. This repositioning is happening while physical silver premiums remain elevated. Coins and bars are still trading well above spot. Industrial users are still locking in supply. If silver were truly weak, physical demand would collapse. It hasn't, not even close. So what does that tell us? It tells us the paper price is being used as cover for exits, cover for transfers, cover for what I call the silver exit. And the silver exit isn't retail panic selling, it's institutional rotation. It's big players moving from visible, reportable exposure into quieter, less transparent forms of ownership. Off exchange, off balance sheet, long term. This is where history matters. Every major precious metals move starts this way. Sideways price, exploding volume, confusing signals. Analysts say nothing's happening. And then, suddenly, liquidity disappears. And here's the hidden connection most people miss. This silver activity lines up almost perfectly with stress showing up in other markets, particularly U.S. Treasuries and credit spreads. When confidence in paper assets wobbles, silver doesn't spike immediately. It gets prepared. That preparation phase is what you're watching right now. And here's the kicker. The people exiting visible paper silver positions aren't bearish on silver. They're bearish on the system that prices it. That's a critical distinction. Because when the exit finishes, when the repositioning is complete, price no longer needs to be controlled. And that's when moves get violent. Now we've covered what happened and we've covered the numbers. But the most important part is still ahead. Because next, I'm going to show you the real reason this is happening and the exact mechanism that could force silver higher or lower fast. And depending on which side you're on, the next move could either wipe you out or put you years ahead. So don't go anywhere. So now let's talk about the real reason this is happening. Because once you see this, the entire silver market snaps into focus. This isn't about inflation headlines. It's not about green energy demand. And it's definitely not about retail traders on Reddit. This is about liquidity. Right now, the global financial system is starving for clean collateral. U.S. Treasuries are flooding the market, repo rates are flashing warning signs, and banks are quietly tightening internal risk limits. When that happens, institutions don't rush into risk assets. They rush into optional liquidity. Assets that can sit quietly, be rehypothecated if needed, and explode higher if confidence breaks. Silver fits that profile perfectly. But here's the problem. You can't build long-term strategic exposure to silver through COMEX futures forever. Those positions are transparent. They're margin dependent. And most importantly, they're vulnerable to forced liquidation. So what do smart money players do? They exit loudly and re-enter silently. That's the silver exit. The exit is from visible leverage. The entry is into physical allocation, long-dated swaps, private vaulting arrangements, and bilateral contracts that never show up in daily volume reports. That's why price looks dead while pressure keeps building underneath. Now let's talk about the mechanism, because this is where things can turn fast. Silver is one of the smallest major markets on Earth. It trades like a commodity, but it behaves like a monetary metal under stress. That combination is dangerous, because when positioning flips, there's not enough depth to absorb it smoothly. Here's how the squeeze scenario works. First, paper positioning gets stretched. Too many contracts, too little deliverable supply. Second, a catalyst hits. Maybe a rate shock, maybe a credit event, maybe a geopolitical headline. Third, margin requirements change. That forces leveraged longs and shorts to react immediately. And when that happens, the weakest participants get flushed. That flush looks bearish at first. Price dips, sentiment collapses. Commentators declare silver dead again. But underneath that drop, physical demand doesn't blink. In fact, it accelerates. Because industrial users and sovereign buyers don't care about daily candles, they care about availability. Once availability becomes the concern, futures stop mattering. And here's the key point most people miss. Silver doesn't need everyone to buy. It only needs one class of buyer to refuse to sell. If just a small percentage of holders decide they won't part with physical silver at current prices, the market breaks. Not slowly, instantly. Now, let's be fair. There is a bearish case here, and we need to talk about it. Bearish case number 1. If the dollar strengthens sharply in a risk-off event, silver could be temporarily crushed as funds scramble for cash. That's happened before, and it can happen again. Bearish case number 2. If industrial demand forecasts are revised down due to a global slowdown, paper traders will front-run that narrative hard. Bearish case number 3. If regulators step in with rule changes, position limits, margin hikes, it can delay the upside and shake out weak hands. Those risks are real. But now listen carefully to the bullish case, because this is where the asymmetry shows up. Bullish case number 1, physical silver inventories are already thin. There is no buffer. Any sustained increase in demand creates immediate stress. Bullish case number 2, silver is historically undervalued relative to gold. That ratio doesn't stay extreme forever. When it snaps back, silver moves violently. Bullish case number 3, and this is the big one, confidence in paper promises is eroding. Slowly at first, then all at once. Silver is not priced for distrust. It's priced for normalcy. And normalcy is exactly what the global system no longer has. For long-term stackers, this means patience matters more than timing. The exit you're seeing now isn't the move, it's the setup. For traders, this means volatility is coming. Direction will be fast. Stops will be hunted. You either understand the structure or you become liquidity for someone who does. And for everyone watching this thinking, I'll wait until it breaks out. By the time silver looks obvious, the silver exit will already be complete, because exits never look like exits while they're happening. They look boring, they look confusing, they look like nothing, until suddenly, they look like everything. Now in the final part, I'm going to break this down into 3 clear takeaways, what this means for you, what to watch next, and the single signal that tells you the window is closing. And I'll also tell you exactly what I'm watching in the next few days that could confirm this whole thesis or invalidate it. Don't miss it. All right, let's lock this in. 3 takeaways. No noise, no fluff, just what actually matters. Number 1, and this is the most important, price is lying to you. Silver's current price is not a reflection of supply, demand, or risk. It's a reflection of positioning. And positioning is changing right now, quietly, systematically. The silver exit isn't about panic, it's about preparation. If you're waiting for the price to confirm the story, you're already late, because by the time the price moves, the exit is finished. Number 2, Paper silver is becoming less relevant by the day. Futures volume is exploding while physical availability stays tight. That divergence never resolves peacefully. It resolves with force. Either paper collapses into physical demand, or physical scarcity drags paper price violently higher. There is no third option. This is not a theory. This is how every structurally tight market ends. Number 3, watch behavior, not headlines. Ignore what analysts say. Ignore daily candles. Watch inventory levels. Watch delivery requests. Watch lease rates. When those start moving together, the window closes, and when the window closes, silver doesn't give you time to think. This is the part where most people get it wrong. They think the opportunity is the breakout. They think the opportunity is the headline. They think the opportunity is when everyone agrees. It's not. The opportunity is when nothing seems to be happening, but everything is being positioned. That's where we are right now. Now, here's what I'm watching next. If we see continued high volume with muted price, that tells us the exit is still in progress. If we see a sharp dip that fails to trigger physical selling, that's a warning shot. And if we see inventories drop while price stays flat, that's confirmation. Because silver doesn't ring a bell at the bottom. It pulls the floor out from under you. So here's my question for you, and I want you to answer this in the comments. Do you think silver breaks higher through a squeeze? Or does the system try one last shakeout first? Type squeeze or shakeout below. I read every single one. And if you know someone who's still watching silver price alone, no positioning, no structure, share this video with them. It might save them years. If you want to stay ahead of these moves before they show up in mainstream media, make sure you're subscribed. This market rewards preparation, not reaction. And as always, none of this is financial advice. These are my opinions. Based on public data and market structure, you are responsible for your own decisions. But remember this. This wasn't random. This wasn't a coincidence. This was planned. And the silver exit is already underway. I'll see you in the next one.